Welcome to the HC Commodities Podcast, a podcast dedicated to the commodities sector and the people within it. I'm your host, Paul Chapman. This podcast is produced by HC Group, a global search firm dedicated to the commodities sector. On September the 19th in New York City, we held our latest HC Commodities Podcast live event, this time hosted by ITFA, the International Trade and Forfeiting Association. With over 150 guests at the Yale Club in Midtown New York, our panel discussed commodity trading in volatile times. ITFA itself is the World Trade Association for companies, financial institutions, and intermediaries engaged in global trade, supply chains, and receivables financing. Founded in 1999, ITFA is an association made up of around 320 members located across 60 different countries. ITFA brings together banks and financial institutions who are engaged in originating and distributing trade-related risk and finding creative ways to mitigate risks. I'll put a link in the show notes to the organization. They hold numerous events throughout the year, and they were great hosts. The event was also co-sponsored by HC Group, Brown Brothers Harriman, Goba Capital, and Mercury Resources. To discuss commodity trading in volatile times were our panel: Rob Walsh, CEO of IMI, Will Tully, Head of Business Development at Brown Brothers Harriman, Commodities and Logistics, Sunil George, Head of Client Financing Solutions for the Americas for Louis Dreyfus Company, Todd Lynady, Regional Head of Financial Solutions at WTW, and Alexandre Lacreu, Chief Underwriting Officer at Coface North America. We had some challenges around the audio recording, particularly at the beginning of the session, so we've lost a few minutes. However, I started by asking Rob Walsh to give us some sense of the volatility that has been impacting the commodities trading sector since COVID, and whether much of that is sustained or ephemeral.
Yeah, indeed. I think in our lifetimes, I don't know that there's been a sustained period of volatility, let's say waves on an ocean that just keep coming and coming. You know, we've seen individual events like 1997 or 2001 or 2008, et cetera, but they tended to be sort of short-lived and in a way, ring-fenced. So to frame out this conversation, I think it would be productive just to take a little walk down memory lane or a little refresher course of the events that we have seen since 2020 or in the last 5 years. So certainly, as the the highlight performer, we had our first global pandemic. We had a first. I think everyone in the room would agree that was the most life-altering event that we've been involved in as a room, as a country, and as a globe. If we look at a category next door, if we look at logistics immediately following COVID, when we sort of had a recovery and let's say a resurgence, we had this dramatic supply chain and labor crisis. It wasn't only here; it was worldwide. Shortly after that, we had the Ever Given, beached or went aground in the Suez Canal, stopping traffic there. Shortly after that, we had the low water event in the Panama Canal. And at the same time, concurrently, we had Houthi attacks from Yemen and the Red Sea, stopping shipping traffic in the Red Sea. So individually, any one of those are pretty dramatic events, and we're really seeing them in sort of quick succession. Geopolitically, if we look at some global events, post-COVID, between COVID and now, the U.S. has spent $4.5 trillion or dispensed $4.5 trillion in stimulus money. The EU has spent $2 trillion, so $4.5 trillion for the U.S., $2 trillion for the EU, $2 trillion for China, and another $600 billion that was just announced a couple of weeks ago. So we're approaching $10 trillion in stimulus money. We've never seen that in our time, right? This is something, when you add it all together, it's kind of head scratching, And so what happens when you add $10 trillion to the global economy? You have inflation, right? So this is also something that we haven't seen since the 1970s, where you have almost double-digit inflation. Of course, what happens when you have inflation? You have interest rates because Fed and finance officials have to step on the brakes or slam on the brakes. And so we've had that, something that's also very dramatic in the last 5 years. I would go on to say that, in a geopolitical front, we can't deny or we can't ignore the atrocities that are occurring right now in the Ukraine and in Israel. Devastating, brutal wars that are carrying out right in front of us with dramatic effects in everything that we do. And the result of that, aside from the U.S. fighting and Europe fighting a war with a currency war, we're also fighting a sanctions war. That also is fairly new and unprecedented in our time. And then just as a sidebar to all of that, we have a simmering trade battle between China and the West. Okay, so that's just some of the events, right? And so I think it's important to frame it out there. And I'm sorry to suck all the oxygen out of the room here, but what does this mean for a commodity trader? So for a merchant commodity trader, what it means is that if you are healthy, if you're quick, if you're middle-sized or large-sized, and if you have a full toolbox, this is an unprecedented time for you. And there were plenty of opportunities or opportunities to serve the global need, which I think is what commodity traders do in times like that. And they adjust the delivery channels and trade channels in lightning quick speed. And so I think, yes, to answer your question, Paul, shortly, it is unprecedented time. And I think for the healthy merchant commodity trader, it was also a very exciting time to be in the business.
There's there's a great description of the events that happen. Some of those are structural and seem that they're going to be around for quite some time, and the industry is adjusting. Okay, am I back now? And some of those are short term. I don't know, across the panel we've got financiers, we've got underwriters. Can you give us some sense of, William, let's start with you on the banking side, right? Like, how do you define what's structural and actually what you need to prepare for? And then obviously there's these short-term events, all of it roils into one. You say, Rob, it's great to be healthy. There's also an impact on the smaller companies we come on to. But can you give us some sense that you manage that?
Gosh, I think as a bank that is financing physical commodities merchants, we've been doing this for almost 200 years. We've also seen tons of volatility over the past 5 years, and I think some of it is here to stay. Some of it is temporary. I know that from the financing perspective, it appears as though there is volatility here to stay. The big events that occurred over the past 5 years in my mind were, one, COVID, the onset of that, the early months of that, demand dried up, prices fell, people didn't know what was happening in the world. And so as a result, our clients were, borrowing a fraction of what they were just a few months before. Then you fast forward to the next sort of events in my mind, which is February 2022, when Russia invaded Ukraine. There was a tremendous demand for credit. And all of a sudden, every trader was scrambling to get access to liquidity, to capture the opportunities. Prices were rising. And then, just a few months after that, when the Fed, started to raise rates towards the end of 2022, you got backwardation in a lot of commodity markets. And traders, the last thing they wanted to do was to be financing inventory. The debt was more expensive. When you were rolling your hedges, you were just losing money month in and month out. And so people were borrowing a lot less. So, the conclusion to all of this is I think this volatility has created, unpredictability in the need for credit.
Does that not just raise prices, lower profits? Todd?
And we're seeing this with a lot of our clients as well, right? So, we're talking about a lot of large issues that occurred throughout, the last 5 years, but we also have to see what was happening a little bit, not at the super micro level, but a micro level, where you had a lot of the traditional trade finance commodity banks get out of the market, right? So what did that do to even some of the stronger middle and large? They had less access to liquidity. So there was a lot of players out there that needed liquidity. didn't have their partners there for them as they had in the past. You have a lot of underwriters on the trade credit side pulling out of certain type of commodity business due to ESG mandates within their firms. So, what we see here is, the Minsky effect, right? You have the pendulum swinging really hard one way, really hard the other way. And, you add on top of that rising interest rates, banks pulling back. So where do the traders go? They have to now they have to tap into the asset management, private credit, which we all know have a lot larger margin requirements than, let's say, 2 to 3 point spreads that most banks are able to generate, but they want double digits, so that hurts. And for credit insurers looking to underwrite some of these entities, that's really difficult to figure out, okay, how is this particular company who used to borrow at 2 or 3 point spread, now borrowing at a 7 to 8 to 9 point spread, how are they going to continue to service this debt? How are they going to be able to remain solvent? How are they going to be able to just service their customers? And I have that's where, in addition to some of these other structural issues, we're going to see and continue to see pain as banks kind of come in and come out. But unfortunately, a lot of the banks that did go out have not come back in.
Yeah. And this all leads up to the impact piece. And I guess we talk about it on the pod quite a bit. You're kind of trying to bucket these different sources of change, and you've got decarbonization, that whole energy transition, which is changing financiers' expectations around their customers and so forth, as well as consumer tastes and industries itself, which is creating technology volatility, all that piece. You've got deglobalization, which you can put in there, sanctions, the Houthis, trade wars, tariffs, and then you've got digitization, which is, it has been effective in lowering costs, but also increases transparency, which can, in markets and so forth, that changes the game. So I guess, Alex, it'd be great to get your perspective on that, because, again, you face quite a disruptive world, and some elements of, volatility is great for trading, as you pointed out. You're solving problems in time, space, and form, but actually if it gets too volatile, it actually starts to disrupt and distort trades and create challenges around, the typical flows of commodities which we need all in our daily lives. I mean, how do Coface manage, I guess, that complex picture?
The credit insurance market is pretty large for us, so we are pretty well diversified, which is also helping to mitigate the risk we have on some of these geographies and some of these industries, obviously. I think since pandemic, and obviously the huge disruption associated to COVID-19, it was a pretty smooth and easy time for us with a very low credit risk out there because of the abundant liquidity we have seen on the market provided by the different central banks. And we have seen a very low level of bankruptcies, basically, which is usually impacting our activity. And since, I would say, 18 months now, definitely bankruptcies are back to where they were pre-pandemic. So that will be one of the challenges we are facing as credit insurer. But I think it's interesting to see that, yes, there is this external shock creating some volatility, but some of these trends are also longer term. And I think it's interesting you mentioned the trade war, because trade wars are here to last. I think the hyper-globalization era is behind us now. It's pretty clear. The only thing is, it's taking time to decouple some economies, large economies like US and China, as you mentioned, but also EU and Russia. And in the meantime, what's happening is that we are observing a transfer of these activities and this transaction to third-party countries. Like Mexico is a good example, with definitely overtaking China as the main source of imports for the US. And we could also ask ourselves, is it normal to see this surge of activity between EU and some Central Asia countries, such like Uzbekistan or Kazakhstan? Probably there is a transfer of the previous transaction with Russia going through these countries now. I think it's pretty obvious. So for this case, we are thinking more like a longer trend. You also mentioned the energy transition. I think this is also a longer trend. I think in the next decades, we will see a higher demand for specific metals like copper, aluminium, nickel, or cobalt. Actually, when you look at the IEA report that was released last week on the renewables, it's pretty interesting for me. There is a few takeaways in this report. First, they project that in the next 6 years, the amount of renewable energy in the mix of total energy will increase from 13% to 20%. And most of this increase in capacity for new energy will come from solar energy, solar photovoltaic energy. Wind will play its role as well, but it mainly come from solar energy. And solar energy producing for panel is mainly coming from China, as we know. So here again, we are going back to the trade war. It will be interesting to see how countries are reacting to this. It's pretty obvious right now that US and India are trying to bring the manufacturing back to their country, even if it's at a higher cost. So you can see also the electric vehicle share increasing in the total new vehicle sold every quarter, basically. For the past 2 years, I think it increased by 3 points in the US. And we are seeing the same thing in EU, and that's one of the main targets of the tariff implemented by both US and EU against China. So I think all this trend is telling us that there is a big polarization happening right now in the global economy, and this will have major impact in the trade exchange. And as a credit insurer, we'll have to shift also our coverage from one country to another. That's what we observed with Russia, where we had a significant exposure. We are not so exposed to Ukraine because we are already pretty restrictive since the invasion of Crimea in 2014. But we are seeing a shift of our clients and of their needs from one region to another because of all this mechanic happening behind.
Yeah, well said. And some of that, then the sanctions come down, right? That creates a lot of uncertainty, and it can be quite immediate, and those cause lots of the challenges we've seen in the last couple of years. Sunil, I guess just getting your final comment on the volatility section before we talk about the impacts. Can you just sort of give us some sense of, obviously in Latin America and so forth, where you're seeing how this is impacting the trade and the opportunity down there?
I fully agree with the responses from the fellow panelists. One thing we have to keep in mind is that up until 2019, the world is not really used to uncertainties. Suddenly we got a black swan event and then the world is not ready, and we weathered quite a lot. And what that immediately created in the market is nothing but a supply disruption because people couldn't work. And we figured that out with a lot of stimuluses from a lot of governments, and as you rightly said, the world has seen a lot of liquidity. And what has happened in 2022 is that, okay, it's a man-made crisis, which is nothing but the war. When Russia attacked Ukraine, you created another disruption in the market. So what has happened is that, the central banks were trying to tame the inflation quite a bit by increasing the pricing. And then what happened with the man-made crises like wars, you also create supply disruptions because the commodities won't be reaching in places where it is really needed because the imbalances of the inventory. So when the same thing happened, not only the FOB prices of commodities went up because imbalance, uncertainty, and also you look at the freight cost went up because a lot of uncertainty, and risk mitigants like the insurance tools in the market has gone up, because you have to cover for the vessels, and then there were not many insurance companies who were covering for the insurances. And the political risk premiums also went up. And on top of that, the financing premiums also gone high because the banks do not want to take the risk on uncertain assets. So as a result, the inflation started spiking up, especially in developing countries. And then that created, a lot of imported inflation into those countries because the cost of financing in those countries spiked up to maybe 20%. The banks are not financing. And then the same thing happened in 2020 when there is a lot of fraud events happened in Singapore. Many of these big trade finance players have pulled out right before the Russia-Ukraine war, and there was a vacuum already in the trade finance space. And that has exacerbated the deficiency of trade finance availability in the market. And as a result, the world has gone into more and more chaos. Right now, what we are seeing, in my opinion, is nothing but the volatility which will be created from the new war, what we are seeing in the Middle East. And what happens, okay, if there is a Strait of Hormuz which will be blocked, we don't know. We are living in terrible uncertainty and what will be the price of oil and how it is going to basically disrupt the entire supply chain, not only in terms of price of oil. Price of oil means the freight prices will go up, all the commodity prices will go up in all the countries, including the US. There will be imbalances of inventories available in different places. And how do we weather that? We don't even know. So the experiences of all these black swan events and even man-made crises, although we have learned something, in my eyes, we are getting new problems every day, and it is translating it into major problems. And on top of that, the climate impact, which is nothing but the natural disasters, what we are seeing in different parts of the world, it is also creating imbalances. You look at the drought in Brazil, drought which happened in so many countries, flooding which happened in 2023 in almost 10 countries in in a matter of 12 days. And it's all created deficiency of commodities and the Chinese demand. I mean, like with an aging population, how the world is basically going to, create that demand, because China was the powerhouse of creating demand for the last 30 years. And then the Chinese economy is also going to grow only at 4.5% as opposed to 8.5% in the last several years. So where do we find alternative demand? The world will basically shuffle, the commodity markets will really shuffle. But to me, all this really shows is that we need to find new innovative tools in risk mitigation. And that is where, we need to struggle. I mean, the world will continue. We have seen even more chaotic events in the world, but we have evolved. And at the same time, we need to be creative. And that is what I really wanted people in this room to basically come, especially the bankers and the insurance companies. And we should be collaborating in terms of developing new products. Products such as regenerative agriculture, which I really want to touch base from a commodities perspective. I was reading somewhere that in the next 60 years, the fertile soil in the world will be depleted almost by 100%, which means that we will not be having food on the table, basically, if it continues. What are the new steps which we really want to mitigate, bring on table in order to mitigate those kind of risks so that we can feed the 8 billion people, and not only that, it is growing as well. So regenerative agriculture is one of the areas which basically all the financiers and the traders and the farmers will have to basically think over. And today is a very great day from my perspective because it's the World Food Day. And then, there are over 570 million farmers across the globe, I was reading today, and 90% of that are smallhold farmers. And if you really want to create scale in a process like regenerative agriculture, we cannot do it alone. You cannot create scale. You need to get a poly-capital kind of an approach where different capital providers will need to come together, collaborate. I'm not talking only about...
The challenge... Sorry, like the challenge is in some ways, right, and the impacts of this is you've had 15 years of relatively low volatility, post-financial call, let's say 10. You had consolidation across the sector in commodities trading, a lot of that driven by regulation, in banks getting out in particular. Low returns shove some others out, and you come to quite a consolidated world of commodity traders. Now, if you look at the energy crisis in Europe, there's a decent argument to say that the existence of a liberalized energy market solved those problems pretty quickly. But I would argue that we're now entering a period of increasing protectionism, government regulation. Certainly, you've highlighted increasing costs. And I think Rob alluded to already, there aren't going to be innovative market solutions to manage this risk and global efficient commodity flows if there aren't the companies there to do it, and it's controlled by a small number and then very fragmented at the bottom. And it seems to me that's kind of what's happened, and I guess...
So just to address a point that you made, or a comment that you made, Paul, that, how does this affect pricing? And as I was preparing for this conversation, I went and looked at a few curves, 5 years in arrears, and the numbers were kind of startling to me, and I'm in this game every day, but if you look at lithium, we had a high price of $85,000 in 2023. Today, the price is $9,500. If you look at cobalt, a high of $80,000 in 2022. Today, $24,000. If you look at nickel, $50,000 in 2022. We had the nickel squeeze, which we're all aware of. It went up to $100,000, but let's just disregard that as tomfoolery. Today, $17,000. So even with all of this volatility that's happening, the market's still doing just fine. We don't have a shortage of battery metals. I don't think we have a shortage of rare earth metals. I think despite the fact that we're in a bipolar, or I don't know if you can have a tripolar world, but that's kind of what we have with I think India and the Middle East and Brazil are largely sort of charting their own course away from the mess that's occurring or unfolding, the Main Street brawl that's unfolding between China and the EU and the US. But from a commodity trading perspective, I think that largely gets ignored. To your point, from a insurance perspective, from a trade finance perspective, and from a structural perspective, from a regulatory perspective, compliance, did I say compliance twice? All those become more complicated. But traders are very quick, very nimble, and very creative, and they will solve all these problems. So I think, largely speaking, the world is in a good place, despite the fact that all of us pointed out a lot of terrible things going on. I can go on. Iron ore was the price of $240. Today it's at $100. Brent crude was $130 in 2022. Today it's at $70. Right. So we're in a very healthy position here from a commodity pricing perspective. Now, to your point about the consolidation, this is the issue. So if we look forward and we look to the energy transition, we know that the mining of these raw earths, of these battery metals, is going to have to continue. We know that mining projects are going to have to become larger and in more unsavory places. And we know that the trading companies and mining companies are fewer, right? And so this is going to be an issue that we face. But I don't think it's going to be an issue that we face in the near term. I think it's something that we're going to have to be aware of. I'm not sure that there's anything that anyone in this room can do to solve it. But it's just something that we can be mindful of.
The energy and resources sector is experiencing unprecedented change. To help companies navigate this world and capture its opportunities, HC Group launched Enco Insights in 2023. Enco has rapidly become the leading global experts network dedicated to energy and resources. Enco Insights leverages HC Group's 20 years of connections and dedication to the sector to give clients the expertise they need to take decisions fast. Connect with Enco's experts for anything from a 1-hour insights call to a longer-term consulting project at encoinsights.com.
Yeah. But I guess, you do have a small number of very large commodity traders, and then the rest of the market, it seems to me, is quite fragmented. Maybe, William, we can turn to you. How do you then support those smaller companies, especially when they're facing such significant costs around compliance and all of these other regulatory factors that are coming in that weren't there 10 years ago? And you've got shifting landscapes that can be very hard to navigate if you don't have a global footprint.
It's a very difficult period for these companies to navigate that. If you're the CFO of sort of a medium-sized commodity trader and you've just lived through the past 5 years and all the volatility and the unpredictability of your financing needs, you are going to be looking to raise as much liquidity as possible. Many of them have very large accordions in their credit facilities so that they can access those if this volatility returns. And many of them are using the banks to sort of provide in many ways backup liquidity options, sort of insurance policies that are largely going unutilized in today's environment, knowing that perhaps there will be a continuation of this volatility and they may need that extra liquidity in the future. So that's sort of a general comment around the industry. Then if you segment it into sort of the large players and the small and medium-sized players, like you said, it's a lot easier for the larger players to access that liquidity today. Many of the traditional commodity trade finance banks have focused on those big players and are not really interested in working with the small to medium-sized folks. Luckily, there are people like Brown Brothers and other players in the industry that are still interested in that, but not nearly as many as there were 5 to 10 years ago.
Todd, any?
See, I think that's one of the bigger issues, and I'm looking at it more on the credit side, right, in terms of access to liquidity. I was with the bank today, and one of the things that they mentioned, totally outside of commodities, but they're tapped out on all auto exposure, right? So when you have this flight to quality, as Sunil brought up, a lot of the fraud that happened in APAC really just shut down a lot of the trade finance banks that focused on commodities, but also the insurance carriers. And I was at an insurance carrier when a lot of this went down. So we saw there was that reaction to kind of pull back and take that flight to quality. So if we get to a point where some of these smaller and mid-sized companies basically can't sustain themselves and then sell to a larger firm, and then some of these commodity traders, to use maybe a little bit more of a cliche of too big to fail. And then all of a sudden, the banks that do provide the liquidity to the business that hasn't taken out or come off of the commodity business, when they get tapped out, what's going to happen to the rest of the market? Is there going to be that liquidity available for them to sustain themselves? And I think we have a little bit of a perfect storm going on between now we're seeing rates coming down a little bit, but we have higher rates than we had historically. We have the geopolitical issues. You had a lot of disruption in just different trade flows, and I mentioned it before, the ESG mandates really start hitting these mid-sized markets because the big traders could only do so much. A lot of the trades that you see is in the mid-market, so how will they sustain themselves? And that's one of my bigger concerns, and what I see with our client base is, how can they tap into what they need to continue to go as, a sustainable business?
Yeah. Alex?
Yeah, for credit insurance, I think there is two main roles we can play for commodity traders. Obviously, there is a credit risk coverage, right? Usually commodity trading, it's pretty large volume, very thin margin, which is giving a very little room for commodity traders to absorb any large credit loss. And I think that's where credit insurance can definitely help to support them going after business that would be difficult to take otherwise. And the second piece is that many times, and I'm speaking under your control, banks tend to be more inclined to finance AR when they are insured. So that's where also credit insurance can help. We are not financing the company, but usually we are an important piece when it comes to financing the ARR of the commodity trader, which is a big part of their assets. So they usually look for financing on the AR piece.
Thanks. We're obviously struggling with some slight technical issues here. Okay, right. So I guess, is there massive unpriced risk in the market? All these commodities have come off. If you were at the beginning of the year, there was lots of stories about copper going to X and lithium being unavailable and oil, hitting the moon. And none of that has really materialized, but there's still these huge significant risks out there. And as you said, William, as a banker, your clients need to have that liquidity available because we all remember what happened in 22. Just in terms of today, how as a mid-sized trader, as a commodity trader, a participant in these markets, whether you are an underwriter, and a financier, a trader, you said this at the start, Rob, being a good and healthy company. How are you a good and healthy company? How can organizations prepare themselves to weather the next 5 years, given all the volatility that's at play, but also the potential risks that are out there?
Yeah. Am I on?
No.
Nope. Thank you, sir.
Improvise.
Let me fish around in your shirt here, buddy. Oh, look at that. Yeah. You're good. We'll just share. Thank you. Thank goodness you're wearing an undershirt.
That's a commodity trader at work, that is. Yeah.
Insurance broker for you. Thank you. Thanks, Paul. It's a challenge. So I think when you talk about, when I made a comment about being a healthy commodity trader, to me that means that you have a full toolbox. And what goes into a full toolbox? So you have to have the ability to originate tons, which means that you have to have the cash, the trade finance lines available to go into very, very emerging markets and put cash on the barrel to secure volume. And that's risky and it's challenging. You have to have the logistics capability to be able to find a location to store and blend and hold title to those materials. That also is challenging. You have to have the ability to manage the logistics piece of it, which is... You're first. All right, sweet. We're going to Mike's. The logistics piece of it, which is ocean freight, barging, railing. And then you have to have the ability to manage the distribution side of it, the last mile delivery, and finance all of it. You have to have, all of the things that I mentioned before. You have to do compliance, KYCs, make sure you're dealing with good guys. All of these things are extremely costly and take time to put in place. So you can't just jump into the commodity trading game from Monday to Tuesday. It's a game that takes in our case, decades to get to this point, really, to get that toolbox full. And then you have to have a global commercial team that can take care of ARBs, ARB opportunities, carry trades, and spreads, right? If you're going to compete, you have to be able to be savvy in every one of those things: origination, delivery, last mile delivery. I'm talking about ocean-going delivery, last mile delivery, KYCs and compliance, trade finance, insurance, and then ARB models, carry trade, spreads. And the derivatives piece, right? If you're going to do all of this, you have to be extremely sophisticated at the derivatives piece, right? Just from a hedging perspective alone, if you're carrying your own inventory at source, you have to be good at hedging, right? So you put all these things together, and it's very difficult to get into this business. And so it's no wonder that it's become smaller and smaller and more consolidated. Yeah.
But on the derivatives piece, that volatility itself has driven in a whole slew of different sources of capital and investment that have different goals, right, than your traditional trader. You're talking CTAs, long-only funds, and we've seen that in metals this year when it's market sentiment, right, tweets and so forth, or X's, whatever they're called, can drive markets way outside the fundamentals, which also then poses a problem, again, for those mid-sized traders. It's incredible. And also, add to all of that now government relations. How do I get ahead of some of this regulation and policy so that I'm not blindsided when it happens, or I can capture that opportunity, if things like the IRA come along and actually it's could be a potential boon to my business and so forth. William, how do you guys, when you're looking at organizations to support, what are you looking for in terms of robustness to weather this?
We look at the people first and foremost. We want to find good partners to work with, and we want a long-term relationship with someone that we can support through the ups and downs. That's number one for us. And obviously, a strong balance sheet is also key, and a moat around the business is also key. But first and foremost, it's the people.
Yeah. Which are, I'll talk
my banker, ladies and gentlemen.
Harder to find, right? I mean, you've had 10 years of consolidation. There are fewer seats in commodities than there were 10 years ago. There are fewer organizations that have those seats. So the world hasn't been generating new commodity traders in particularly great volume over the last 15 years. So actually, on the people side, it's really challenging to find the people to fill those roles as well, at caliber. Well, let's end before everyone gets too frustrated that they just walk out, and we will get to the bar. I guess, final bit, when we look forward, there's always a sense like, if we were in 2013, we were talking about how volatile markets were, and oil was just going to march upwards, and commodity prices were going through the roof, and so forth. And then a year later, the music stopped. And I always think about that today. There seems to be really good arguments why the volatility is going to be sustained and structural for the long term. When you think of things like the energy transition, we seem to be entering a real period of protectionism, deglobalization, to use the word. But there are other reasons why, again, it might just be quite transient. Let's just, I guess, go down the line. Todd, on balance over the next decade, continuing volatility or in the rearview mirror?
I think it's going to be continued, and I think what you're going to see is continued consolidation. I think what Robert said, the sophistication needed to run a profitable, strong, resilient commodity trading company is different now than it's ever been. If you look back over the years, you saw a lot of people and companies just spring up because they had a great book, right? They had great contacts, they had great relationships, and they were able to trade commodities, and it was a lot, I don't want to say easy, but it was much more straightforward. There's so many different factors that have to be at play now, and I think the small guys and even some of the middle-sized guys are just going to have to basically join forces to basically be able to, really embrace and like, for lack of a better term, crack the nut that you're going to see coming down the pike in the next, 5, 10, 15 years.
Am I next?
Testing.
I think that we're going to see plenty of action, plenty of volatility, or volatile times. I think that, headlining that, you have the energy transition, which is going to compete against AI, right? And so the consumption demands are growing, faster than we're putting in new sustainable energy. That's going to be very interesting to watch. We have to add in nuclear and hydrogen to that. So that's a very interesting subject line. Geopolitically, for sure, the next 5 years are going to be, wildly volatile and maybe harrowing or exciting or scary or all of the above to watch. I don't think we're seeing the end of inflation. I think there's going to be more, Ms. Harris and Mr. Trump spend like TikTok influencers, both of them. And so we're going to have a whole flood of money coming in again. And I actually think we may see, a leveling off of interest rates at 3.5%, 4% at best. We're not going to see the old days. And then weather events, to your point, Sunil, they're going to continue, and supply chain challenges as well. So, but look, through all that, no need for hand-wringing. Your friendly commodity trader is going to be there to make sure that your goods get from point A to point B. And they're going to do it on time with a smile on their face.
Will? I agree with both of you that there will be continued volatility. I think it's going to create continued challenges around financing these businesses, given the unpredictability of it, and the changing landscape in the banking world. It's kind of ironic that our industry, the trade finance industry, is one of the oldest in the world. It traces its roots all the way back to, the Medicis.
Yeah.
And yet, there's this huge sort of private credit world out there with $2 trillion of capital that's been allocated to it that is just barely scratching the surface in the trade commodity finance industry. And so, I wouldn't be surprised that going forward, some of the banks become more originators, structurers of credit, and then, the risk is held by third-party investors through private credit funds and other alternative asset managers.
Yeah, actually, I would like to come back also to the previous point on the toolkit. I think there is one point that's interesting is also the diversification of the commodity trader activity and numbers of products they are covering, and also in numbers of geographies. And actually, we discussed about briefly oil and gas and renewable energy earlier. I think it's interesting to see some moves on the market. Like you have Vitol, which is not a small commodity trading company, who is expanding its activities, and so is Total Energy trading arms as well, now to metals, because I think they are getting prepared for the next decades. And they need to start now, right? Because it takes a while to get to know your market, and they know that. So I think it's an important point. Now going back to your question, yes, volatility will continue. I think you mentioned a very interesting point earlier with the Strait of Hormuz. I think that's at very short term something we should all watch, especially for the oil and gas industry, obviously, where we could potentially have big disruption for the oil and gas industry with product coming from Bahrain or Kuwait. And not like for the Red Sea, I think there is less alternative for the Strait of Hormuz. So this could be a big challenge for the oil and gas industry. So definitely more volatility, and I think that's where diversification make a lot of sense for commodity traders.
Yeah. I mean, and talking to those traders that are getting into metals, it's specifically because historically you could be an oil trader and you didn't need to care about what was going on in metals, right? Whereas now actually to be able to have that longer range forecast, just being connected to your customers, you need to start having a broader suite of commodity offering that gives you that, the robustness for the energy transition.
And obviously, we didn't have a chance also to touch some topics with relationship with producer. You mentioned the due diligence you are doing. I think creating strong bonds with your producer is key to maintain a steady flow of raw material and to secure this raw material in the future. And we didn't have a chance to speak about prepayments, but I think since the financial crisis of 2007, 2008, it has been an increasing source of financing for the producers, provided by the trade commodities firms themselves, mainly the big one. But I think that was also an interesting move in the market for the past decade, and it will continue probably as it goes.
Sunil?
Yeah, definitely. I have to agree with all the fellow panelists that volatility is here to stay. But to me, what is more important is nothing but how do we manage the risk. especially when it comes to financing the SME players. The alternative financing, like what role are they going to play? Can the industry really afford the double-digit kind of numbers? Where will protectionism take us? Where will trade wars take us? Where will regionalization of the trade blocks, the creation of the trade blocks take us? All these are events which will potentially disrupt and is not going to have a solution in the next couple of years. I think it's going to continue into the next decade as well. And more importantly, coming from the agricultural space, I have to say that the biggest risk what the planet is facing is nothing but the weather risk. Man-made crisis can be negotiated, but weather risk is something which we have to really put our brains into in terms of mitigating to make sure that we have enough food on the table to feed the people, and also other renewable energy sources, and then we have water on our waterways and rivers and all the channels which is transporting goods from one point to the other. How can we be more sustainable? For bringing the goods in the right place at the right time, but more sustainably. I think sustainability is one of the key things which we all have to keep in mind going forward. Personal responsibility and also collectively, corporate and also as a society, we need to keep that in mind.
Thank you, everyone. Thank you very much to the panel. Thank you for listening. To find out more about HC Group, our global offices, and our expertise in search within the commodities sector, please visit www.hcgroup.global.